Hi there, I'm champion trader Kevin Davey, and today I'm going to talk to you about five big mistakes. Five big mistakes that algo traders make. Let's get started. Okay, well, let's talk about five big mistakes that algo traders make. First, a disclaimer: don't trade with money you can't afford to lose. Past performance is not indicative of future results, and treat all results as hypothetical. Okay, so first, I want to share with you my trading history. The first 10 years of my trading, I did everything wrong. Anything possible, I did wrong. Revenge traded, over leveraged, kept buying losers, averaging down, all sorts of crazy things. But the good part was that kind of led me to do some in-depth digging and research and try to figure out what was going wrong. And eventually, I kind of took what the lessons I learned from losing and combined it with my own psychology and my own feelings, and it led me to algo trading and where I am today. So that was a big breakthrough. When I stopped making some of the just common mistakes that a lot of algo traders make, and I created a solid development process for my own trading, things started to improve. So here's my process. I call it the strategy factory. It's a simple process where you go step by step from goals all the way through to a created final strategy, and you run it with full money. Obviously, there's a lot of detail in each of these points, but that's the basic process I use. And I found that by using this process, I'm able to save a lot of money because I eliminate a lot of mistakes. And I'm just going to talk about five of them, and they occur at different steps in my process. And it's kind of the way I built my process is to eliminate them. Now, you probably have a lot of these mistakes in your own strategy development because they're pretty common. But let's talk about each one. So let's start out with mistake number one. Mistake number one is with getting ideas. And so many people get hung up on getting ideas. They think they have to reinvent the theory of economics, and start from scratch to develop a trading algo. And that's just not true. A lot of people think they're not creative enough, and they think, oh man, I could never come up with an algo that works. Everything's already been done. Or they say to themselves, that'll never work. That's way too simple. That's just not going to work. So people throw up a lot of roadblocks before they even go and test things. And that's a big mistake. You don't have to start from scratch. You can take what other people have done and just make it your own. You don't want to replicate what somebody else has done exactly, but you can certainly take what they've done and kind of add to it. I do that all the time. Other people think, hey, I got to look at a chart and figure things out. And what they'll do is they'll pull up a chart and they'll find a couple times when something works, or sometimes it doesn't, a couple times it doesn't work. And they'll think, oh, okay, well, that's something I want to trade. And a lot of people just go off and trade it. And that doesn't work either. It can be the start of an idea, but eventually you have to test it over more than just one chart. I can't tell you the number of people who look at a chart and draw conclusions that are supposed to last for years or decades. And that doesn't happen when you look at one chart. It can be a start, though. And then a lot of people also think that ideas that they come up with have to be complicated. Or maybe that artificial intelligence has to generate them. That's the big talk now, is everything's got to be AI. Well, from my experience, what I've seen is a lot of these programs that automatically build strategies for you or that use AI aren't really that smart. And what they give you is just a bunch of data mining. They look at the past data and say, oh, hey, every Tuesday at 2 o'clock for the past 10 weeks, the price has gone up. So therefore, AI says that's when you should buy. And it could just be a fluke. So you got to watch out for those kind of things with your ideas. But the key, and I've kind of alluded to it, is to test it. You've got to test whatever idea you do. So I grab ideas from wherever I can. I use my experience. I'll use other people's ideas. I might use machine building to give me like the raw ideas as long as I don't test it on a lot of data. But I'm constantly looking for new ideas. And then when I get them, I test them. And I literally have a list of ideas that is a mile long practically. So it's not literally a mile long, but it's a long list of ideas that I want to test. And that's what I do. So I never run out of ideas. Because when you run out of ideas to test, how are you going to build strategies? That's the way I look at it. So I look for ideas everywhere I can find them. And a couple of the keys that I've found: one, you modify them to make them your own. And two, you got to do the testing. You can't just come up with ideas and start trading them. That'd be foolish. But if you do some rigorous testing as part of that, then you're in good shape. So that's mistake number one. Mistake number two deals with testing. And specifically, it's over-optimizing. So many traders over-optimize, and they create what they think is a better and better backtest. And it actually is a better backtest on historical data. But remember that warning I gave at the beginning where it said past performance is not indicative of future results. Creating a great backtest, that's nice, but it doesn't necessarily mean it'll work going forward. Here's how most people do it. They take all their parameters, 20, 30 parameters, all these ranges, and then they throw it with all the historical data, throw it in the optimization engine, which the trading software loves, because it loves running exhaustive optimization. It loves running genetic optimization. It gives you a set of best parameters, and it'll tell you use these parameters. That historically was the best. And a lot of people take that and start trading with it, and that's just a huge mistake. It's just the wrong way to do it. So if you get nothing else out of this video, just remember traditional optimization is bad. It's really bad. Creates a great backtest, but that's not the whole story. So what you've got to use is something called out of sample testing. I use walk forward testing, which is a specific way to get the most out of sample testing. But even that can be exploited and can be tricked. And you can easily over-optimize walk-forward testing. And you might be saying, whoa, wait a minute. I've always heard out-of-sample and walk-forward is the way to avoid it. Now you're telling me it can happen? How? Here's an example. Let's say you run an out-of-sample test, which is great, okay? And you look at it and you're like, it looks okay. I can do better. So you go back and improve it. And then you get the second set of results. Oh, it looks better out of sample. Oh, I'm getting closer. And it's out of sample, so you think this is good. And then you improve it again. And then you get your third out of sample test. And you're like, wow, I'm really nailing it now. And this is out of sample, so this should be good. And then you improve it again. The problem is, every time you do this little improvement, your out of sample isn't quite out of sample anymore. Maybe it's 90% out of sample, and then 80%, and then 50%, and 20%. Pretty soon it's just like in sample because you've tested it over and over again. And you can do this with pure out-of-sample testing. You can do this with walk-forward testing. I specifically teach my students a certain way to do walk-forward testing that helps prevent this. But what you should realize is that doing a test, looking at out-of-sample results, and then making a decision whether you should test some more is a really, really big mistake. It's almost as bad as what I showed earlier with just the optimizing like crazy. So don't think just because you have out-of-sample that it's done correctly. This all comes back to building a better backtest and how you shouldn't do it. If you go to my website, there's an article I wrote for Futures Magazine, which is now defunct, but it was Don't Build a Better Backtest. And when it first came out, it got a lot of controversy. People were kind of mad about it. They were like, what do you mean, don't build a better backtest? You say you should backtest as an algo trader. Now you're saying you shouldn't. What's going on? Well, you do backtest, but you got to watch out because the goal isn't to create a great backtest. It's to create a backtest that works well going forward. Don't lose sight of that. Most people do. So, to prevent mistake number 2, I do some limited testing first when I play around with different concepts, and I only use a couple years of data, and then I gently optimize. So if I'm running a stop from, let's say, $500 to $1,000, I don't make steps of every $25. I take big steps, $250. So therefore, I test $500 stop, $750 stop, $1,000 stop. I try not to get too detailed because that usually leads to over-optimization, where you think, oh, $673 is the right value. Oh, that's the key to market success. It doesn't work that way. So stop thinking that. And then the second part of it is I do in-depth walk-forward testing. I try to test one time only. I keep the number of variables low, and when I'm working with walk-forward, there's an in-sample period and an out-of-sample period. I don't optimize those values at all. That keeps me out of trouble. Okay, so mistake number 3. Mistake number 3 happens during the incubation phase after you've developed it and you're watching the strategy and the diversification position sizing phase. So what this is all about is knowing what's good and what's not good. Honestly, a lot of traders look at certain performance numbers and they can't really tell what performance is good and what's bad. So what do I mean by that? Well, here's an example. Here's some walk-forward test results. What do you think? Are these good strategies or are they not? Probably if I had a poll for you guys, I'd get mixed results. Some people would say, hey, these are all good. Some would say, oh, half of them are good. Some people would say these are not straight lines, so they're all bad. You can't really just tell from an equity curve, right? And in the future, who knows what the equity curve is going to do? It might continue on like this. It might run into big drawdowns. So it's kind of hard to say. But the solution to all this is you got to have goals and objectives up front, because if you don't know what's good and what you're looking for is acceptable, then you're going to keep trying to do what we said earlier, make a better backtest, and that just doesn't work. And the second part of it is you need confidence in whatever metrics you use and whatever numbers you use, that they're going to lead to acceptable performance in the future. So what I do for this, to avoid this mistake, I have goals and objectives. I also have hurdles, or basically interim objectives at every step of my development process. And then I've done this development process hundreds, probably thousands of times, and I've seen it work in the real world. So I know that the criteria I put in place works. And until you have that criteria, you don't really know if what you're asking for works. Is 500% a year something reasonable with a strategy? Some people would say yes. Some people would say no. And if you don't know the answer, that's something you have to investigate and see. So knowing this up front will help you develop a strategy, because there's nothing like thinking you can do something and then just going back and tweaking it and adding rules and filters until you finally have the perfect strategy. What I found is that typically doesn't work. Okay, so some of my personal hurdles for my development: I want to make sure when I do preliminary testing, almost anything I do makes money. 10K per year per contract seems to work out pretty good as far as a result after I do walk forward testing. I have some Monte Carlo simulation criteria that I like to use. And then I like to have some minimum performance after I develop the strategy before I go live. But the key with all this, you might have different numbers, is to know what you want and then use that as your criteria. Okay, so we've made it about halfway through. Can you do me a big favor at this point? If you've liked what you've heard so far, please subscribe to my channel. That keeps me making videos. If I know people are subscribing, I know I'm delivering good content. Of course, if you don't like this, don't subscribe. And then, if you're interested, head over to my website. A link is in the description, and you can get a free E-mini S&P trading algo. And of course, I always like likes. Likes. Yep. Say that a couple times fast. Likes. So more likes means more videos that I create. So if you like it, please give it a thumbs up. That's the feedback I know that I'm reaching you and that I'm actually delivering good stuff, which I think I am. But the likes help. All right, so let's look at mistake number 4. And mistake number 4 can happen at a couple different points in the process. And it's really knowing what metrics to choose and which to avoid. So it's a little similar to mistake number 3, but it's different. I mean, I've seen people rely on win percentage. That's all that matters. Profit factor, max drawdown. I've even seen people come up with crazy metrics that actually encourage losing trades, believe it or not. But when you do the math, it comes out that a higher losing percentage is actually good for their metric, and they claim this is the way to do it. It's weird, but there's so many metrics to use. You open up a report in TradeStation, for example, a strategy performance report, and you'll see tons of metrics. So what metrics are important? It's hard to say. It depends on you for the most part. But the truth is, all of them can be important and all of them can be useless. The problem is you'll never find a strategy where they're all good. You know, tons of profit, super low drawdown, 90% winning percentage. Those things don't exist. And when you start looking for them, you start to get into trouble. So you shouldn't even start looking. Here's an interesting one. The trading legend Bob Pardo, I'm sure you've heard of him. He wrote in his one book that net profit is not a good optimization technique, or it's not a good metric to use. And in fact, he mentions it a couple times and basically says only an idiot would use it. Uh-oh, I guess I'm an idiot, because for years I've been using net profit during some of my process as the criteria. My theory is, if there's no net profit at certain steps of the process, why bother? The profit's not going to show up later. If the profit's not there at the beginning, it's not going to be there at the end. If anything, it gets worse. So I use net profit quite a bit. Now, I don't use it at the very end. I also include drawdown. But this is a good example of somebody who thinks net profit is terrible. That's Bob Pardo. And somebody who thinks net profit can be pretty useful, and that's me. And that's a key point. What somebody else says might not be what you think. So you've got to find metrics that support what you're doing. But most importantly, it doesn't matter what I say, what Bob Pardo says, what any expert says. It's what your real performance says. And if your real money performance is off, maybe you're not using the right metrics to measure and develop your trading systems. Okay? So that trumps everything. Because this isn't rocket science. A lot of people like to think it is, but trust me, I did an internship at NASA one summer when I was in college, and I did actual rocket science stuff. So I know what rocket science is. And trading and developing trading algos is not rocket science, because rocket science uses a set of equations to get to the moon, for example. And it's pretty set. You know, you mess up the equations, you're not going to get to the moon. But if you do them right, you'll get there. Trading isn't necessarily like that, because a lot of times there are no right answers, right and wrong answers. There's best practices, and the process I use, for example, I consider a best practice, but it's not the only right way to do it. There are other right ways, and so that's what you got to remember. There is no one right answer, and there is no one wrong answer. There's just a lot of best practices. Okay, so let's go on to mistake number 5. And this occurs when you're doing full money, full size, true operation in real time with real money. And it's not knowing when to quit. I wrote an article a number of years ago about when to quit a trading strategy, and it almost didn't get published because the editor was like, nobody talks about this. Nobody talks about quitting. You need to write an article about the Lamborghinis you're going to buy and the models who are going to be swimming in your hot tub. That's what you need to focus on, not quitting a losing strategy. Who reads that? But the funny thing is, he printed it anyways, and I got a lot of feedback from it that people were like, yeah, no one ever talked about this before. Now, 8-9 years later, a lot of people talk about quitting strategies. But back then, it didn't really happen. So you really have to ask yourself, what if things go wrong with my new algo strategy that I just rolled out? What do I do? Because this is what happens to a lot of people. You know, you create a back test, which is the chart on the left. Then you go live right after the red line, and things fall apart. And then you tear your hair out like this guy. You know, it's sad, but this is what happens to a lot of people. And a lot of people will just ride that strategy down till it hits zero or until they run out of money. And that's just a big mistake. They think about it before it's too late. So what I'm saying here with this mistake, the way to overcome it is think about when you're going to quit before you start trading a system. And there are a lot of different ways you can do it, and you can argue that one's better than the other. I don't know if I've necessarily seen that, but the key is having a point written down when you quit. You share it with your trading partner or a significant other, or share it in general with somebody on the internet. Doesn't matter. Just share it where you're held accountable, and then you follow it. And if you don't follow it, hopefully somebody's there to help keep you accountable. So you write it down, you share it, and then you stick to it. And that will help you quit systems before they go too bad. So what I do, one of the things I do, is let's say my expected performance is that green dashed line, and my blue is my real performance. I'll have a quitting point that if my equity ever goes below that quitting point, I'll just
Order
stop
filled.
trading the strategy. Seems pretty simple. In reality, it's pretty hard to stick to it, but if you do, you're going to save yourself a lot of money in the long run. Because this is a big mistake where people just go like crazy and trade until they run out of money. So, those are the 5 mistakes. Thinking you don't have ideas or not having ideas, over optimizing, knowing what a good strategy is and knowing that up front before you start developing, using the wrong metrics that don't support how you're building systems, and then not knowing when to quit an algo you're running. The key for all these that I've found is if you have a process to develop strategies that take all these things into account, you'll be much better off because you can actually prevent a lot of these things from just upending your trading. Okay, so if you have questions, please feel free. Reach out. Send me an email, kdavey@kgatradingsystems.com. I'd love hearing from other traders. And again, more likes means more videos, so like it. Well, you can only like it once, but, still, like it. Because that'll keep me developing. And if you haven't subscribed, subscribe. Then you get little notifications every time I make a new video, which I try to do that 1 or 2 a week. Sometimes it's 1 or 2 a month. But the more subscribers I have, the more likely I am to make more videos. And then don't forget, go to my website if you want to get a free S&P algo. All right. So thanks for watching. I'm Champion Trader Kevin Davey. Have a great day.